Hi, this is Chapter 2. It's on financing, the notes and mortgage section. The objectives in this chapter are to define a mortgage note, explain and define a mortgage, identify the different mortgage clauses, explain and identify what constitutes a mortgage default and foreclosure, and also to identify and explain alternatives to foreclosure and define and explain bankruptcy. Again, as we'll find in these first couple of chapters especially, we need a lot of definitions to make sure we can get through the rest of the book. Definition of a mortgage is a transaction where one party pledges real property to another party as security for the obligation owed to that party. So the difference is that the mortgage is where you're pledging the property to the real property as security. It goes along with the promissory note. So it's executed, that's what a promissory note is, executed with a mortgage. The note creates the obligation to repay the loan in accordance with some terms, but it's secured by the mortgage. So they are two separate securities that work together. The typical type mortgage that we think of is when a seller is willing to take back a mortgage, so borrow, as part of its full payment for the purchase price. And we call this a purchase money mortgage. And that's the way most of our real estate mortgages work. You might say, well, isn't that the way all of them work? And say, no, because you may refinance. For example, when I owned one house and was going to buy another house, I refinanced for more than the amount of the loan, therefore ended up with some money that I could put down on another house. So it was to put down, but not in the same house. So it would not be considered a purchase money mortgage. Or I could have done anything with the money. I could have used it to buy a car or put on an addition. So it wasn't a purchase money mortgage. Another type of financing instrument is a land contract. In this case, the seller promises to convey title to the property at such time as the purchaser completes the performance of some obligation called for in the contract. So in this case, the land contract buyer does not have title. If you don't have title, then you cannot mortgage the property or sell the property. Okay, you can't do anything like that. That's the difference between a land contract. Key thing there, that the land contract, that the contract buyer does not have title. The essential elements of a mortgage loan, things that you'd have to know, are the amount borrowed, the rate of interest to be charged, is it fixed or is it a adjustable rate, which we'll talk about a lot in chapters 4 and 5, the amount of the loan, the due date, the term, the payment amount, the maturity date, reference to the mortgage's default, what you'd have to do to be in default, penalties for late payment. Some other essential elements in most mortgages, the acceleration clause, which we'll talk about in a little more depth in a second, the recourse and non-recourse. So if you default on your mortgage and note, could they go for more and your property ends up being less than the value of the note, so the property goes down in value? If they have a recourse loan, that means they can go after you personally for the extra amount. Non-recourse, they could not. Assumability, we'll talk about more in a moment. Further advances and release of a lien. Let's talk about these in more depth. The acceleration clause is very important because it says that notice must be given to the mortgagor that specifies the default and how and when the default may be cured, and that the failure to cure the default may result in acceleration, which is the full payment of the debt secured by the mortgage. So they're saying with the acceleration clause, if you default, if you don't meet your obligations, then the bank who you're borrowing it from can accelerate it and say it's all due right now. The prepayment clause that permits the borrower to make payments in advance. And it could just be as much as just paying another $100 a month to paying it off in full. Now, there may be what's called a prepayment penalty. This often comes up with some of the newer interest-only and option arm loans. And what that would say is that, well, yes, you could prepay it, but there'll be a penalty. So, for example, if you pay in the first 3 years, you'd have to pay 1 to 3% of the principal amount outstanding. And that would be your penalty to prepay. And then after generally some amount of time, 3 or 4 years, there is no prepayment penalty at that point. This would be all written in the prepayment clause. Due on sale clause allows the mortgagee to accelerate debt when the property is sold without written consent of the mortgagee. So they don't have to, go and write to them and say, "Can we pay this off because we're selling it?" If they do have a sale, then they can pay it off. Assumption of mortgage clause. When a mortgagor owns a property and grants the property to another property, and the grantee assumes the grantor's mortgage. So first of all, the loan has to be able to be assumable. If it's assumable, then you can, give it to someone else, and they would assume it. So unless the previous owner was released from the debt, though, the previous owner can be held liable if the new owner defaults on the debt. So it can be assumable, but you'd have to find out, did the previous owner get released or not? Otherwise, they still are on the mortgage and still can be liable for the debt. Acquiring the title subject to a mortgage. Here, the mortgagor is definitely responsible if the person acquiring the property defaults. The person acquiring only gets title if the mortgage is paid off in this case. I put this in, we needed to have it somewhere, but often comes up is, what does this cover as far as the property? And we talked about, well, it's the real estate property, it's the land, all the improvements it's made to it, everything that's not movable. One of those things would be a fixture. It's the debate of what is a fixture. So it's part of the tangible personal property that has become affixed or is extended to the use with the real estate. So oftentimes they'll say do a walkthrough when you are purchasing property, and the seller should put in any exemptions. So otherwise, anything that's affixed to, so chandeliers, window treatments that are nailed into the walls, stoves, things like that are all considered fixtures and to be left on the property unless there is an exemption that the buyer agrees to. And this can become an argument, so we want to make sure we understood what that was. Other mortgage clauses that are often put in are that taxes and insurance are often required as part of the monthly payment. This is to protect the bank so that the property is insured, which you'll see is the bottom bullet point here, is that they often require, almost always require, you to have hazard insurance against fire, theft, and so forth, destruction of the property. If it's in a flood zone, they would require flood insurance. So they require that you have it, but to ensure that you pay it, they'll have you pay it to them every month, and then they can pay it to the insurance company. Taxes is the same thing, because if you don't pay your taxes, then the town or state will put a lien on the property, and that will eventually, if you defaulted, would become a problem to deal with the mortgagee. So they want to make sure the taxes are paid too. They also would require payment of all taxes, assessments, charges, and claims that were assessed on the property prior to it. So they're not going to give you the mortgage unless all of those are taken care of first. Another mortgage clause would be a maintenance clause, which says that you must preserve and maintain the property. Okay, so you can't just let it fall apart. And also subordination, that anything that comes, any mortgages, loans that come in after yours would be junior to your senior mortgage. The basic mortgage requirements are that the borrower and the lender is identified. There's a description of the property. There's covenants of the warranty or the promise and binding insurance. Provision between spouses that needs to be taken care of, and covenants and other contractual agreements that might be added. A mortgage default is the breach of a mortgage contract and a note. So this could be the installment payment. It could be that you didn't pay your taxes and or insurance. It could be something such as keeping up one of the agreements, such as failure to keep the property in good repair. So if you broke that, they could push you into default. A foreclosure is the actual sale of the property by the courts to satisfy an unpaid debt. Okay, so default would mean that you broke the contract that would give the mortgagee the right to foreclose, which would be to sell your property. Foreclosing is very expensive, so banks would rather work out an alternative or a workout, I should say. Some of these would be restructuring the mortgage loan, so they might extend, say, if you had 25 years left on your mortgage, maybe they write another 30-year or a 40-year mortgage. Maybe they give you a reduced rate for the next 3 to 5 years, and then kick it up after that. They might transfer a mortgage to a new owner. So if you found someone else that you could say they'll take it over, they might do that. But then again, there's a risk that the new buyer will default, but they could consider it. Voluntary conveyance of the title of the mortgage. In other words, it's often called deed in lieu of foreclosure. It has the advantage of speed and minimizes the expenses. It's a problem if there's junior liens because those aren't released. But if there's no junior liens, and generally if the property is at or above the value of the lien, then banks would like to do this, the deed in lieu of foreclosure. So you just basically hand them over the property. It's theirs. They won't come after you because they're assuming that the property is at or above the value of the loan, and you just basically walk away. A friendly foreclosure, the borrower submits to the jurisdiction of the court, and better protection if there's bankruptcy. So in this case, it's friendly. They work it or try to work it out. They're not fighting the foreclosure, but the borrower would be probably in better situation if they went to bankruptcy. So the next thing would be with the pre-packaged bankruptcy. So before filing for bankruptcy, because once you're in bankruptcy now, the bankruptcy court's going to come in and make a lot of decisions. But before filing for bankruptcy, the borrower agrees with all their creditors to the terms in which they will turn their assets over to the creditors in exchange for a discharge of the liabilities and can save time and expenses. So they kind of try to work it all out before and then go into bankruptcy with everything worked out with their creditors. Equity of redemption. That's the right of the mortgagor to redeem his property from default during the period from the time of the default until the foreclosure proceedings are begun. So if the person can come up with the money to basically pay all the missed payments they've met, they can redeem themselves. In about half the states in the U.S., there's something called the statutory redemption, which also gives you the right to redeem even after foreclosure. So, and it's usually 1 to 6 months. So in these states, you'd have even more risk of buying a foreclosed property because there's a possibility after you've purchased it that the person comes through and has a statutory redemption after you've already purchased it. So you may want to wait till that time period is over in those states. As we talk about the sale of the property, when you have a foreclosure, we talk about a public auction. You must have a public auction, but oftentimes the only person to even make an offer is the mortgagee, and that bid would only be for the full amount of their claim when that claim is less than or equal to the market value of the property less the costs. Okay. The court makes no representation concerning the nature of the title that the buyer will receive at a foreclosure. So if you're going to buy a foreclosed property, talking other than the mortgagee, the court's not going to say that the title is clear. Purchase of the foreclosed property takes over free of lien on the mortgage is being foreclosed. So that mortgage would be off but other liens may be there. Deficiency judgment. Well, if there is a recourse loan, then any deficiency remaining after the foreclosure and the sale, the mortgagor may have a deficiency judgment, but these are all unsecured claims, and they take their place along with any unsecured debts of the mortgagor. So if you end up that the property was only worth $150,000 and the mortgage was $200,000, so there's a $50,000 that they could say was a deficiency judgment, and they can try to get that from the mortgagor, but again, there may be other people after them, and they'd have to just put that unsecured claim in alongside everyone else's debts. Bankruptcy itself is just the proceeding in which the court takes over the property of a debtor to satisfy the claims of the creditors. And the goal in bankruptcy is to relieve the debtor of all liability so that they become financially solvent again. And there's generally three ways to do this. The first is Chapter 7, and this gives debtors a fresh start by discharging all of their debts and liquidating their non-exempt assets. Okay. You can only do this every 6 years. The next is Chapter 11. This is available to owners of businesses, and it's really looking for the preservation of the debtor's assets while there's a plan of reorganization to rehabilitate the debtor. The objective is to provide for a court-supervised reorganization rather than a liquidation. And again, you can only do this every 6 years, so this is for businesses. They're not looking to liquidate, they're looking to reorganize so the company can get back up on its feet again. Chapter 13, bankruptcy. It'd be an alternative to Chapter 7, liquidation. So it's formulation of a plan designed to rehabilitate a debtor, again, but to qualify you must have regular income and unsecured debts of less than $100,000 and secured debts of less than $350,000. And during the period covered by the plan, the creditor must accept payment as provided by the plan. Although, one kind of caveat is that the rights of the secured lenders, so which in most cases would be the mortgagor, cannot be modified. So you can claim as often as you need it, but in good faith. So one of the things to think about here is say, well, but they can't be modified. But months, maybe years could have gone by through this time of going through the bankruptcy. And although the payments that are due right now can't be modified, the amount to put themselves back and indemnify themselves, get themselves back on track, that may be spread over a longer period of time. So it makes it much harder for foreclosure to occur.